cash is not a good place to have your money during high inflation, and trying to time the market, trying to get out and then thinking that you're going to get back in when the market goes up, it's a myth, and it doesn't work. And I want to show everybody a little, just draw it on a chart here. If I can get this where the camera can see it. Can you see it okay? Mm-hmm. All right, here's my great chart. We'll get another.
We had to practice because
we had to practice.
We have to do it opposite because of the mirroring of the camera.
Do I have to turn this way? There we go.
That's good.
So if this is a chart of the stock market, and the stock market's going along, and then there's a downturn. And there's a downturn like this, like we're in right now. What happens is people get to where they just can't take it anymore. Some people panic. People that are watching the news too much or watching their accounts too often start freaking out. Hopefully none of our clients, or not very many of our clients, have done that. But at some point, they, like let's say right here, they say, I can't take it anymore, and they sell right here. And then the stock market goes down a little bit more, and they're thinking, boy, that's a good thing I got out when I did. I didn't lose. I only had lost 10% or 20%, and it went down another 5 or 10%. And I'm a genius because I got out when I did. And they're thinking that the stock market's going to keep going down. But at some point, the stock market turns around. It's called capitulation. Enough people have sold, and all the people that are going to sell sold, and then the opportunists come in and buy. And so then the stock market starts going back up. And as it's going back up, this person that sold here is thinking, let's say right here, they're thinking, well, I think it might be going to still go back down. And so I'm not going to buy. They're not willing to buy then. Their idea of selling here was to buy at the bottom. Sell here and then buy at the bottom and take advantage, but they don't have the courage to do that at that point. So then the stock market goes up and they don't buy here, then it gets back up to where they got out, and they think, oh, well, I'm going to wait till it goes back down again and then I'm going to buy, but it doesn't go back down. Instead, the stock market, and this is what happens, it keeps going up, keeps going up, keeps going up, and they end up buying here much higher than when they sold. And they were better off had they just rode it out and come back up. And I can tell you that this is proven with studies over and over and over. And I can attest to it with my experience. I should bend down to the camera. With my experience being in this business for 27 years, almost always when people panic sell and get out of the stock market, when they are willing to get back in, the market is higher than where they got out.
When they're comfortable enough, yeah.
Yeah.
To get back in. And there's, like you said, there's plenty of studies on that, and I'll link that like in our YouTube video and on our website to some of those studies. But one in particular that I found was really interesting was that Putnam did a study, and it was they had done it over a 15-year period, and the 15-year period that they did it included the 2008 financial crisis. And they found that if somebody who had been invested in that 15 years had missed out on just 10 of the best days of market performance days, and it got worse if there was more days that they missed out on, but only 10 of the best days, they had lost almost half of their account value compared to if they would have just stayed in and rode the ups and downs. And part of the reason the market timing fails is that usually the best days of the highest growth in the stock market might be back to back with some of the worst days. And so if you think that you're somehow going to have some kind of crystal ball to be able to time that right,
most people don't have the courage. After the market goes down 3 or 4 or 5% in a day, most average people don't have the gumption to go ahead and buy the next day. We have a number of clients that do that and that are doing it right now, but most people don't. And so if the worst thing that an investor can do is to make investment or financial decisions based on emotions. And the two emotions that kill you are fear and greed.